Hi, let's continue with cost of capital, as we already discussed about different types of cost of capital. Cost of equity shares, cost of preference shares, cost of term loans, and a lot of other costs associated with each and every source of capital. And right now we can discuss about cost of equity. Equity shareholders are supplying the funds to the firm and they are expecting a certain rate of return, which is known as the minimum rate of return from the company as their compensation. That's known as cost of equity. So there are certain expectations for the equity shareholders also, just like other suppliers of funds. So the minimum rate of return expected by the equity shareholders from the firm for the supply of funds, that's known as cost of equity share capital. So cost of equity share capital can be calculated on the basis of two approaches. First approach is known as dividend growth model approach. This approach states that dividends will grow at a constant rate, or dividend per share will grow at constant rate. Say for example, every year dividend per share is growing at a 10% rate, then you can work out this model. Then the second assumption is expected dividend growth rate should be lesser than the cost of equity. So every company has certain expectations about the growth rate of dividends. If the growth rate of dividend is 10% and the cost of equity is 8%, then you can apply this formula. Otherwise, the cost of equity is greater than the expected dividend growth rate, then this method is not applicable at all. Then this approach never considers the risk. This approach always considers the return alone for calculating the cost of equity. So these are the three most important things has to be considered for calculating the cost of equity under the dividend growth model approach. Let's look into the formula. Cost of equity equals dividend divided by P0, that's known as market price per share, plus G. G is known as growth rate. This DIV1 is known as next year dividend, and P0 is known as market price of the share, and G is known as growth rate. So what's the assumption here? The assumption is the dividends will grow at constant rate for a certain number of years. That's the basic assumption of cost of equity capital calculation here. Let's look into a simple example here. If the dividend for current year is rupees 3 and expecting growth of 10% at constant rate, market price or share is 100. Calculate the cost of equity. So now the dividend per share is given, that's 3 rupees. So next year dividend, that's known as DIV1, that's next year dividend. This is current year dividend. So how you can calculate the next year dividend? That is current year dividend into 1 plus the growth rate is known as next year dividend. D0 into 1 plus G is known as DIV1, which means that 3 is the last year dividend, 1 plus growth rate is 10%, so 0.10 all divided by this P0, that is market price, 100, plus this growth rate is 10%, it's given here 0.10. This is the calculation part. So in simple words, next year dividend divided by current year market price plus growth rate of dividend. That's the formula to calculate the cost of equity. When you apply the things here, you will get the answer 13%. What you can understand from this? This is the minimum rate of return expected by the equity shareholders from the firm. So the cost of equity is 13% under the dividend growth model approach. Second approach is known as CAPM, Capital Asset Pricing Model. This method considers the return as well as risk of that particular company with the help of a simple formula. Let's look into that formula. Cost of equity equals RF plus RM minus RF into beta. What is this RF? RF is known as risk-free rate. It's the rate available to the treasury bills, which is known as risk-free security in the market. This RM is known as market returns. What is the return provided by the stock market on an aggregate basis? That is known as market return. Some people consider Sensex return as market returns. Then again the RF is repeating here, and beta. Beta measures the systematic risk of the security. Beta tells about, how much variation will be the returns as compared to the market returns. So that's the purpose of beta coefficient. So for every stock market, you will get every stock this beta coefficient. The beta is high means that stock or securities with higher risk. That's the meaning of beta. Let's look into a simple example for that. Risk-free return is 10%. Beta is 1.50. Market return is 12.5. Calculate the cost of equity. So here the formula is cost of equity equals RF plus RM minus RF into beta. RF is 10. 10 is risk-free rate. Plus RM is 12.5. That's market return. Minus RF 10 into this beta 1.50. So you will get the cost of equity as 13.75. So under this approach, the minimum rate of return expected by the equity shareholders from the firm is 13.75. So there are two approaches. One is known as dividend growth approach and second one is capital asset pricing model approach. Both approaches are very popular in determining the cost of equity. So what is the condition for CAPM approach? Company shares must be quoted in the stock exchange. That's the most important point. And second point is all variables in CAPM are market determined and all can be calculated from the stock market. And the value of beta can be determined by way of comparing the stock returns and Sensex returns using some statistical methods. So beta coefficient tells about the risk of the security. These are some assumptions coming under the CAPM approach. And the last one is weighted average cost of capital. As you all know that WACC is known as the overall cost of capital with the company. The company expects a particular rate of return from all projects for giving the compensation to the end-year suppliers of funds. That's known as weighted average cost of capital. There are three steps in calculating the WACC. The first step is known as calculate the cost of each and every source of funds, which means that cost of equity, cost of debt, cost of preference shares, each and every cost must be calculated separately. Then you want to calculate the proportion. Proportion means weight of each and every source. Say for example, the debentures total amount is 1 lakh, total capital is 10 lakh. So 1 lakh divided by 10 lakh. So you will get the weight as 0.10. So likewise you can calculate the weight. Weight is known as the proportion of the sources of fund used in the capital structure. So as a second step, what you want to calculate the proportion of funds, that is weight. First step is cost of each and every source of fund. Then you can calculate and multiply the cost of each source with the proportion or weight in the capital structure. So cost of equity must be multiplied with weight of equity. Cost of preference shares must be multiplied with the weight of preference shares. Likewise, you want to calculate. Then you add the weighted component costs. All these weighted component costs should be added together. You will get WACC, weighted average cost of capital. That's the formula. Let's look into that. W1, that's weight 1. K1, cost of that particular source of capital. Weight 2, cost of the second source of capital. Weight 3, cost of third source of capital. Weight 4, and cost of the fourth source of capital. Let's look into the example for that. Cost of debt is 8, cost of preference share equals 14, cost of equity equals 17, debt or debentures 3 lakh rupees, preference shares 2 lakh, equity capital 5 lakh. So from this, what you want to understand, what's the total capital? 3 lakh plus 2 lakh plus 5 lakh. You will get 10 lakh rupees as total capital. So how you will calculate the weight? Weight 1, 3 lakh divided by 10 lakh, 0.3. And what is the weight of preference shares? Weight 2 lakh divided by 10 lakh, 0.2. And what is the weight of equity capital? 5 lakh divided by 10 lakh, you will get 0.5. So you will get the weight of each and every source of capital here. And the cost is also already given here. Cost of debt is 8. Cost of preference shares 14. Cost of equity is 17. Then you can apply it in the formula W1K1 plus W2K2 plus W3K3 here. What's W1? W1 is 0.3. 0.3 into what is the cost of debt? Cost of debt is given 8 plus what is W2? 0.2 into cost of preference shares 14 plus what is W3? W3 is this one 0.5 into what is the cost of equity? Cost of equity is given, that is 70. So all these added together, which gives you 13.7%. That's the weighted average cost of capital for the company. So this is the way you can calculate WACC, weighted average cost of capital. Thank you.